The bond market just recently went into an inversion in the yield curve. And once it inverts, that's almost always a guarantee that you have a recession further down the road.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is our good friend David Morgan, one of the top silver experts, and he's called the Silver Guru. He runs the MorganReport.com. David, thank you so much for your time today.
Elijah, I always have time for you. Thank you.
All right. Now, the first topic I'd like to discuss is the massive decline in stocks we saw just yesterday. We saw this big decline. It seems like across major indexes, they're down about 3%. The Dow went down 800 points. What is your perspective on why we're seeing this big decline right now?
Well, I think we've seen the top of the market. I mean, there's many proponents that argue otherwise, but certainly it's acting as if it's topping or already topped. And the reason being is that by most metrics, the stock market is overvalued. I've heard others. In fact, I was at a conference recently, just a couple months ago, and there was a panel, and I think 3 out of the 4 on that panel were using metrics of the S&P, and it's really not that overvalued, and they felt the stock market was going higher. I beg to differ. I think that any any normal metric that we would use, it's overvalued. Basically, there aren't any new highs coming out of substance. The FANG stocks that were so popular are showing a lot of weakness. I mean, there's classic signs of a top, and I do think that we're there, and time will tell. So when these sell-offs happen, people will reevaluate, where they're at, how much of a gain or loss they have. And then with tax loss season upon us, there'll be a lot of people that have probably massive gains in the stock market and will want to take some of those profits, and they'll probably look for losses in their portfolio that they can use to, reduce their tax exposure. So I think, again, that we're there. I think that we've had this recovery for a very long time. Interest rates have come up. Interest rates influence the stock market probably more than the gold market, although people may not know that. And the bond market just recently went into an inversion in the yield curve. And once it inverts, that's almost always a guarantee that you have a recession further down the road. So with the recession ahead of us, probably third quarter 2019 or something like that to be officially recognized. The bond market inverting, the bond market showing that it's topped. That's deliberate, absolute on technical work. If you look at the yield curve and you look at like a 30 or 35 year chart on the bond market, you can see that finally that trend has changed. And so all those things together, I think you've seen that reason for these kind of sell-offs. I mean, it's really overbought. And when it's overbought, then any, substantial selling takes it down, rather significantly. I mean, 3% is a huge move in the equity markets, as you well know, Elijah.
Definitely. And with respect to the inversion of the yield curve, how predictive is that? Is that pretty much certain we're going to see a recession then coming soon?
Yeah, I've read it enough times. I should know it from the top of my head, but I don't. But I think it's, it's above 90%. I mean, it almost always is, almost 100% accurate as far as having recession further out.
Definitely. And for our viewers who might not be familiar with this inversion of the yield curve, if I'm correct, essentially it's when the long-term rates fall below the short-term rates, right? And why is that predictive of a recession?
Well, because you need money now faster, so you're willing to pay more for it than you are to loan it at a longer duration. So as an extreme example, a T-bill, which could be, just months in duration, is going to yield X, and a 30-year bond where you should get a higher yield because you're risking your money for a lot longer term could be X minus 10 basis points, for example, which would be a slight version, but still it gives the idea that, well, you want higher interest rates, so you rather loan your money short term. It's less risky, and that is indicative of a recession. So,
now, how are precious metals reacting to all of this? It seems like they're up a bit since we've just in the past couple of days. Do you see this continuing?
Well, it's a tough one. I mean, fundamentally, yes, and over the long term, yes. Over the short term, it's a tougher call. I'm going to actually do an update for our members here later today, but has shown strength. I got to look at the volumes, but there's a shift out of stocks and bonds, and it's usually into the metals, and there's other places to go. Commodities in general. The energy sector is huge. Looks like oil's bottom, so there'll probably be more money coming back into that sector. There's utilities. I mean, there's safe bets. There's other places to invest, but there'll be a rotation. I think that's my point. There'll be a rotation basically out of equities. Bonds, harder to make a bold statement about bonds because you've had major nation states that have kind of moved away from putting as much money into the U.S. debt as in past years. China and Russia, several major nation states have basically backed away from buying U.S. debt. And I think that will continue.
As for like the bigger picture here, I just had Chris Martenson on from Peak Prosperity. He was talking about the coming crisis in the oil sector, and also kind of one of his general themes is that, there's this attitude out there that we can have infinite growth in the economy. We can keep having exponential growth. And that's just not impossible. That's just not possible, I should say, because we live in a finite world. You can't keep growing exponentially forever. And what we're seeing in the oil sector right now, you've commented on this, that there's actually a decline of new oil discoveries. And you're saying that there's probably going to be an oil crisis coming in the near future. How will this impact the energy sector? And then also, maybe my follow-up question, or, maybe later we can talk about how that will impact the economy, because they're really intertwined, the energy sector and the economy. Okay,
well, covered a lot, and I think I've got it all in my head. So first of all, a bit of a shout out to Chris Martenson. Chris and I consider him a friend. We've tried to team up a couple times for seminars. It hasn't worked, but that's an aside. So, yeah, I think Chris is one of the few, this is opinion, that gets the big picture, meaning how important energy is in the overall situation. He also really, really gets the inability of the human species to understand the significance of the exponential curve. And in fact, I just got back from London where I spoke on our new product, which is called Energy Stock Profits. And it wasn't me saying it. You said I did show a curve in my last weekly update that you're referring to, but there's another one that I used from the IEA, the International Energy Association, that shows basically what people have given up on for the most part, and that's peak oil. And I put it in quotation marks. Most people that listen to this channel understand that it doesn't mean you're out of oil. It just means that the easy to get to oil is more and more difficult, and it costs a higher and higher price to get the remaining oil out. So that the IEA states from their curve that it looks like we're peaking around 2023. And if that's true, and I believe it is, along with Chris and others, then there's going to be an energy shortfall. And even if it doesn't peak, the ability to find new oil is extremely difficult, and there is a higher demand for not just oil, but energy overall. I mean, when you have, more than, billions of people that don't have electricity yet, you've got, not half the planet, but almost living on $2.50 a day. There's a lot of demand out there for a higher living standard, and that basically means more energy. So even if, that situation was less dire than I just stated, then still there's a huge demand coming into the fore over the next several years. And because of that, there's a gap. So there's a gap between the amount of energy that we get out of what we call conventional sources like oil and gas, and you could throw coal in there, although we've got a lot of coal. And you have to make that up somehow. So one way is to go more, electrify more things. So this is why it's one of the main reasons that no one talks about why there's a big push for electric vehicles, because you don't run them on oil, you run them on electricity. So that gap has to be filled. And that's why I started this report, Energy Stock Profits, to see that this is a problem. And if you want to be part of the solution, you can be kind of an armchair problem solver, which means if you invest correctly, accurately, and strategically, you can actually use your money to help fill that gap by alternative energies. And I don't have time to go into them, but I touched on all of them, not in depth on this lecture. And we may put the whole seminar or webinar up. It was really a seminar, but it was filmed. We may put the whole thing up on the web in the future. I'm not sure. But I think I touched on everything you talked about. The exponential curve is happening. In fact, one of the first slides I put on this lecture was the amount of energy used and then the population. And it was an exponential curve, and the population grew almost exactly the same rate as the increase in energy available grew. So they're both, hockey sticks, as the parlance likes to talk about them. This cannot go on indefinitely, and that's Chris's point, and that's my point.
Now, how will this impact the economy if we're seeing this oil crisis?
Yeah, well, if you're used to using, you can use the analogy of food intake. I mean, if you're one of the few in America that eats the correct amount of calories per day, and it's 2,000 calories per day, and all of a sudden the most you can get is 1,500 calories per day, you got a problem. You're going to lose any excess weight, and I'm using the assumption that you don't have any excess weight to lose. So you start to decline in your performance because you're not getting enough calories. That's kind of what will happen. And so there has to be something to fill that gap. What is that something? Is it solar? Is it wind? Is it power from the ocean? Is it hydrogen? Is it fuel cells? Is it, there's a lot of alternatives out there. The problem is that there's nothing, and I mean nothing to date, that's as efficient as oil products for transportation. And so much is dependent upon transportation. I mean, not just the airlines, the trucking, and obviously personal transportation. So it's hard to fill that gap with anything but something that efficient. I mean, a gallon of gas has a heck of a lot of energy in it. And that's hard to find anything that could take that volume and give you that much energy. I mean, I just want to emphasize the point. It'll affect everything. I mean, there's nothing more important than energy. And if there's not enough of it, it will affect everything. It'll affect transportation, communication, business, how much food's produced, how much food is transported. I mean, the idea of transporting a bunch of food from let's say South America into the North America so that we can have grapes in the middle of winter may not happen because of the cost of energy to do so. So a lot of things will change, and the change probably won't be instantaneous. It will be kind of subtle for a while. I mean, people will notice that, for an example, you're not getting these juicy grapes in the middle of winter from South America or Mexico anymore. And ask the produce manager at their local grocery store, why not? It's like, cost too much. It's not, it's not economic to bring them up here. Do you want to pay, exaggerate, $10 for, a pound of grapes? Oh, no, okay, oh, I see, that kind of thing. So it'll touch everything. And in ways that, I could talk about, I could speculate for an hour, Elijah, and miss some, but it'll affect just about everything.
And the interesting thing is we're seeing this possibly coinciding with, a decline also just in the economy for separate reasons. So it seems like this all seems to be happening at the same time.
Yeah, it's going to be a tighten your belt. I mean, this recession coming up, I think it will start off rather subtly and rather slowly, and everyone will kind of yawn. Well, we expected it. We knew it was coming and that type of thing. And then it may grind a bit lower, and people say, well, this is kind of a significant recession, And then it might go deeper than that, which is what I expect to see. And once it starts to fall off the cliff and gain momentum to the downside, this is when you might even see the D word appear, depression. And at that point, the Fed and the other central banks will probably panic, but they don't have a lot of room to cut interest rates because they're only up to, pick a number, 4% or something. So they'll do it and they'll try it and it won't work. And this is the point of no return. This is what I see in our future.
All right. Well, David Morgan, thank you so much for your time today. And one of the things that I really like about having you on is you also have a very proactive approach. So do you want to share with the viewers some ways that they can have a proactive approach in this and really not just say, oh, this is awful that this crisis is happening, but actually take steps to prepare themselves?
Yeah, I think you just got to be kind of calm about it. I mean, first of all, emergencies happen. It doesn't have to be financial. I mean, you can have, look at the world today. I mean, earthquakes and volcanoes and, all kinds of stuff happening. The big weather changes that are taking place. So, have some extra food put back. I mean, you don't have to necessarily buy, freeze-dried food. I mean, you could just buy, more canned goods, what you normally buy. And on the freeze-dried thing, I like this, there's soups out there that you get that are packaged that are freeze-dried, and I'll use that water. They're pretty, to me, I think that's a really good way to go. And, financially, I mean, I've talked about that for years, but you don't have to go overboard. And then skill sets, you want to be useful to others and yourself, of course. So maybe something that's a hobby or that you have an interest in. The best place you can put, extra effort or extra time or extra energy is in yourself. Have something that, you could kind of fall back on if times get difficult or you got a different skill set if the job market changes. And obviously, things have changed significantly. I mean, just in my lifetime, what I do for a living now would have been impossible in my 20s because you just didn't have the internet and the computer systems that we have now. And I've built my whole business based upon the fact that we have an internet and I have the ability to do the kind of research I do from anywhere in the world. So it's really, be prepared. There's a lot changing. And as interesting as the future may be, even during the Great Depression, there were a lot of needs, and a lot of needs means a lot of opportunity. So for those that are awake, aware, alive, and, don't give up easy, they persist, their perseverance, and a pretty healthy attitude. If you got a good attitude, I mean, you can get through almost anything. So there'll be opportunity as things change, and I think they're going to change rather drastically. But they have been changing drastically, I think, as we all know. So just be prepared. Don't go overboard. Relax about it. Just take it in stride. It's just one of the things you should do in these times. That's how I would state it.
Awesome. Well, David Morgan, thank you so much for your time. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yeah, I would encourage everybody, if they're not, to get on the free weekly update, which is our podcast. You can just find it on iTunes, type in The Morgan Report, or you can go to themorganreport.com and get on our free email list, and we'll mail you that every weekend. I also do allow others to rent the list from time to time, so you might see some offers on there that appeal to you or don't. You can participate or ignore. It's up to you. But the weekend ones are the ones that are most weighty as far as being of substance or value to someone for free. And I think the last one would be, once you're on that list, depending on what I decide to do with this Energy Stock Profits seminar that I just finished in London. It was about a 5-hour seminar. If you're on that list, I'm sure you'll be, if we decide to parse it out in sections or give you the whole thing or just splice it and dice it and do kind of a mini series or something. If you're on the list, you'll automatically get information about that.
All right, David Morgan, thank you so much for your time, and Merry Christmas to you and everyone else out there. And also, just a shout out, our prayers are going out to our former president, George H.W. Bush, as we remember him and this day off in the markets as our President Trump declared this Wednesday. So, David, thank you so much for your time, and Merry Christmas.
Merry Christmas to you. Thank you, Elijah.